Hello, everybody. Happy Friday. Welcome to the third in a series of free Together San Diego business webinars. I'm Luis Cruz, Community and Public Relations Director at the San Diego Union-Tribune. This morning, representatives from San Diego County Credit Union, San Diego's largest locally owned financial institution, will walk us through the home buying process, including pre-qualifications, title, escrow, appraisals, and inspections. And of course, today's presentation will also touch on buying a home during the current COVID-19 pandemic. After the presentation of about 45 minutes or so, we'll give you an opportunity to ask our panelists some questions, and you can put your questions on the bottom right-hand corner. There's a little tab that says Q&A, so you can start putting in your questions there. All right, let's get started and meet our speakers today. Janie Mera is Senior Vice President, Regional Sales Manager at San Diego County Credit Union. In this role, she oversees the sales and service for 22 of SDCCU's 43 branches in Orange, Riverside, and San Diego counties. This includes developing and implementing strategies to drive credit union growth, coaching, training, and supporting branch management and leveraging technologies to improve processes and the member experience. Dan Kutlayich is also Senior Vice President, Regional Sales Manager at San Diego County Credit Union. Dan leads 21 of SDCCU's 43 branches to achieve organizational goals for all products and services offered. This includes providing input to influence the strategic direction of important policies, procedures, and programs, and coaching and supporting branch management and staff, which includes performance management and development. Janie and Dan, thank you so much for joining us. And a little bit later on, we'll also be joined by Mark Brandcroft, who is the Business Development Officer at SDCCU. Mark will help us with the question and answer portion of the program. All right, Janie and Dan, it's all yours. Take it away.
Well, thank you. Hello, everyone. Happy Friday. Again, my name is Janie Mera. I'd like to thank all of you for joining us virtually today. I know as we are going through some changing times right now where we've had to learn to do things a little bit differently. If you're like me, you've had to learn to work from home. You've had to learn to be a teacher to your children, or you've also learned some patience, or maybe have learned to lose some patience. I'm just saying that. You've also learned to communicate with your friends, family, coworkers electronically. And then you've even learned to maybe take on some new hobbies. So today, let's continue with that trend and let's learn a little bit about real estate, shall we? Next slide, please. Okay. So what are we going to learn today? So I'll be discussing the benefits of owning a home. Is now a good time to buy? How to prepare for your purchase? And then starting the loan process. And then Dan will join in to continue our discussion of the loan and buying processes. With that said, let's get started on the focus of the excitement of what real estate brings. I'm imagining, because you've made time in your busy lives to join us this morning, you're either in the market to buy a home or you plan to buy in the near future. And that is something to really, really celebrate. So I'm going to ask you each to raise your hand, place it over your left shoulder, and pat yourself on the back for taking this first important step of the process, which is educating yourselves. So let's discuss the benefits of home ownership. Building wealth. What do we mean by that? So, well, when a home builds equity, equity is the difference of the value of your home and how much you actually owe. So when you purchase a home with a mortgage, you make your monthly payments, and then each month the payment is applied to your loan balance, and at the same time, home values typically increase or appreciate in value. So as your home value increases and your mortgage loan amount decreases, that spread is equity available to you to access in multiple ways. And then over time, that equity then leads to financial stability. Financial stability. Home ownership can provide a means to cover many of life's events with the equity built, such as for college or education expenses, a home remodel, maybe a wedding or two, and provide peace of mind for eventual retirement. You may also have a goal of leaving a legacy by passing on your home in your estate for your family and children. And then there are tax benefits. Today, interest and property taxes allow most homeowners to potentially itemize deductions on income tax forms and reduce their tax liability. So please consult your tax advisor for specifics relating to your situation. Next slide, please. So many are wondering, is now a good time to buy? So this is maybe the most common question we get. And obviously there's no crystal ball when it comes to the real estate market, but what you do want to consider is purchase power. So purchase power is how much home you can afford in relation to your expenses. Brings up what I like to call the weight versus the rate dilemma. Most buyers just focus on the price of a home, but what you also need to consider is the interest rate and the impact it has on your payment. The lower the rate, the lower the payment, which will increase your purchase power. For example, you may want to buy a home you may wish for a home to drop in price by 50 to 100,000. But at that time, if interest rates increase significantly, your payment could potentially be more than if you had purchased at the higher sales price. So currently we are historically in a low rate environment. This really helps create an affordability opportunity to purchase the home of your dreams, increasing your buying power by affording more of a higher priced home due to the low interest rates. So don't just focus on the price of the home. Rates are just as important. And if the payment is comfortable for you and places you in the right position, then you might be in the right time to buy. So due to the pandemic and the increased unemployment, we are also experiencing less buyers in the market. So fewer offers with less buyers in the market overall. So due to the low inventory, especially here in California, homes for sale, we're often seeing multiple offers, and with so many unknown variables in this new economic environment, it may continue to reduce buyers and reduce the potential for competitive offers. And then there are rent increases and fluctuations. I'm sure any of us who have rented have received notice that rent is going up. Not too fun, right? The current economy can have effects on your landlord's finances, which could increase rent if you are not in a rent-controlled area. So as a renter, you are at the mercy of your landlord, who can sell the property at any time, which may place you in a position of unexpectedly needing to relocate and pay higher rent. So if so, this is where home ownership may provide you the peace of mind by potentially giving a similar and fixed monthly payment. A lot of you may be in a better position than you think. With increasing rents in a lot of these areas, some of you may find that a mortgage payment might even be less than what you're currently paying in rent. Then there are purchase considerations. One of those is income stability. It really is a big commitment, and you want to ensure you have stable income. If you foresee any changes to your income, have concerns about possibly being laid off, or if you're currently furloughed or considering retiring in the next few years, then it might be best to revisit when you feel more stable with your income and with what you can afford. We all know that mortgage payment is a long-term monthly commitment that needs to be paid regardless of your employment status. And then future employment. Could your job or industry be impacted by the pandemic? For example, for those who work in hospitality and suddenly travel and tourism has halted, your employment status may be affected. Or on the bright side, we're now seeing more people going back to work, where home ownership is now more of a reality, and you may feel that a good time to buy is now. So your length of residency. One of the most important questions to ask yourself is this your forever home? How long do you plan on living in your new house? Is this your starter home, or are you looking to relocate in a matter of a few years for job placement, or maybe even getting into a desired school area? So keep in mind, on average, a homeowner purchases every 7 years due to needing either to upsize, downsize, or relocate. Take a look at your cash flow. Did the changing financial markets impact your investments and/or retirement funds that you're planning to use for your down payment? Monitor your accounts. If you're planning to use as a source for your down payment, check your investment accounts, 401k accounts, and get familiar with the available options to use those funds to purchase a home. Also get familiar with any availability restrictions or the accessibility of your funds beforehand. So really overall, for people who feel confident about their job security and finances, they might see it as a perfect time to buy. Mortgage rates have already reached a record low in the beginning of March, making it more affordable for home buyers. So if you're considering to purchase a home prior to the recent events, you don't necessarily have to put your plans on hold. Next slide, please. So prepare to buy. So one of the most important steps of the home buying process is to check your credit. You are entitled to a free credit report a year for each credit bureau. So visit annualcreditreport.com, which is the only federally authorized site for your one free annual credit report. You want to review your FICO score. And a FICO score ranges in numerical value between 350 to 850 that lenders use to determine your credit worthiness. So keep in mind, credit scores may vary by agency, and some borrowers with the same score may receive very different loans depending on the loan offers, depending on the lenders. And then credit issues. If you identify a credit concern or a minor blemish, as my friend likes to call it, you will need to inquire further to possibly satisfy any balances owed, or you may have identified an opportunity to correct an error on your credit report. It's never too late to start improving your credit. Again, you can obtain a consumer-initiated credit report without impacting your score through annualcreditreport.com. And then there's capacity. Lenders look at your capacity to obtain and repay the loan. The more income and assets you have in relation to your debt, the easier it is to qualify. So typically you'll be asked to provide 2 months of history of bank and asset statements, which include savings, 401k, IRA accounts, investments, and gifted funds from lenders. And then you'll also they'll also review your debt ratio, which is a percentage of total debt to income. And then collateral. So collateral is the property itself. Is the home worth the purchase price? Does it need repairs? Does it have termites or any structural problems? There's also loan to value. Loan to value is a percentage of the amount financed compared to the appraised value of the property. So how much will your down payment be? These are a few criteria lenders will be reviewing. And we recommend that members get SDCCU members get a home inspection before they buy. Next slide, please. Next slide, please. So start saving now if you haven't started already. Some people feel most comfortable with putting as much as they can toward a down payment. The more they can put down or put towards closing costs, the better. Based on how much time you have, create a budget, or vice versa. Create a budget and determine how long it will take you to get to your down payment goal. If you have corrections to your credit, you need to allow enough time for the credit reporting agencies to respond to your request before it can be resolved. Make sure the lender is one you trust and understands your needs. Do your research, compare programs, and don't just look at rates. You must look at all the fees, the turnaround times, and communication preference. And is the lender community-based and local? Or maybe some of us like the face-to-face interactions versus taking care of everything electronic and prefer to drop off documents in person. Do research on what the reputation is for service. That's very important. And all these things are things to consider when choosing a lender. Next slide, please. And then my favorite, the do's and don'ts of credit, excuse me. These are very straightforward. Make sure to review these carefully before and during the home buying process. So let's first review the do's. So do check your credit. Do clear up any issues you have on your credit report. Try to reduce debt. keep current on payments, document disputes, and then if possible, consolidate student loans. And then let's take a look at the don't. So don't have inquiries on your credit report, don't open any new credit, don't become delinquent on any payments, don't co-sign for debt, and then don't close revolving accounts and don't balance transfer. So again, pretty straightforward. It's so important to keep these in mind, where some people have been pre-qualified for a home loan and unable to close on their loan because they no longer qualify due to the changes to their credit and changes to their debt to income. They start buying cars and you start financing appliances or co-sign for family members. The process can be long, so please be sure you're in a stable point with your debt and employment. Next slide, please. And then the loan process. It's also important to understand the loan process and seek a pre-qualification. A pre-qualification is simply an estimate of what the borrower can afford, which is typically based solely upon verbal data given from the borrower. You can seek a pre-qualification with most all lenders. Some of the criteria needed for an application are social security number, a credit score, a property address, estimated property value, asset balances, down payment amount, sources of income, and then a 2-year employment history. And if there is someone else on the loan with you, like your spouse, significant other, or a family member, keep in mind they'll need to supply their information as well. So once you've completed an application, you will then be able to lock in a rate. You will also receive a loan estimate that will cover all the costs associated with your loan. Next slide, please. And as previously mentioned, it's important to get pre-qualified prior to shopping for a home. Not only do you need to select the right agent and lender, but you need to select the right terms for yourself. SDCCU is a direct lender where brokers are different. They are incentivized for originating loans, and some are paid strictly on commission. So let's take a look at the type of mortgages. So a fixed mortgage rate is fixed for the entire term of the loan, where the interest rate and payment do not change. It's ideal for those who want a consistent payment each month and plan on staying in their home long term. The most common loan terms are 10, 15, 20, or 30 years. And then there's an adjustable rate mortgage, or ARM, is where the interest rate can fluctuate depending on what the rate is tied to, and therefore your payment will change too. So it usually allows for a lower interest rate initially, but this can increase over time when it adjusts. The most common ARMs adjust every 5 or 7 years. So an SDCCU mortgage loan officer can go over these programs with you in more detail and help you decide which is best for you. So I want to thank you, everyone. I'll turn it over to my partner, Dan Kalayich, to dig deeper into loans and buying details. Thank you, everyone. Take it away, Dan.
Next slide, please. Thank you so much, Janie, for sharing that very insightful information. So to begin, some of you might be asking, what are some of the fees and costs associated with obtaining a home loan? Great question. First, it's important to understand that you will receive an upfront detailed list of any fees or costs that may be charged during the home loan process on a document named the loan estimate that Janie mentioned earlier. So let's review these fees and costs in detail. First, there are loan origination fees, also known as an application fee. This is exactly as it sounds. It is essentially a fee paid to help cover some of the costs associated with obtaining a home loan. Then there's points. These are fees paid directly to the lender at closing in exchange for a reduced interest rate. Some may also, or it may also be known as buying down the rate, which can help lower your monthly home loan payments and reduce the total interest paid over the course of the loan. Title and insurance search. This is for an examination of public records to determine and confirm a property's legal ownership, and also to find out if there are any outstanding claims or liens on the property. Of course, a clean title is required for any real estate transaction in the borrower's best interest. Appraisal. So this helps to ensure you understand whether the home is worth what the seller is asking for. And it helps the lender determine the max loan amount for the property. Survey. This will be a detailed inspection of the property's condition. The surveyor will inspect the property and highlight structural problems for major repairs or alterations that may be needed. A few examples are perhaps unstable walls, the roof needs to be replaced, and plumbing or electrical problems that may need action before the home is purchased. Recording fee. This is a fee for registering or recording a real estate purchase or sale so that it becomes a matter of public record, which is consistent with all property purchases and sales, and this fee is charged by a government agency. And finally, mortgage interest. This is upfront prepaid interest, and the amount owed fluctuates depending on when the closing takes place. So it's not a set amount, it will fluctuate depending on, again, the time of the month the closing will take place. Next slide, please. The loan estimate will also provide monthly payment details, which is important because it helps you understand the financial impact on your monthly budget. Very important. Similar to most loans, the different parts of a home loan payment consist of principal and interest. For those who may be unfamiliar, the principal is a portion of your payment that is applied to the loan balance, which decreases the total amount owed. And the interest is a portion of the payment that is paid to the lender. For many mortgage loan products, the interest paid on a monthly basis typically decreases with each payment made as well. Then there is an escrow account, which may be part of your payment. So some borrowers may choose to have an escrow account for peace of mind, so they don't have to worry about large lump sum payments due for taxes or insurance each year. Other borrowers may decline an escrow account and will be solely responsible for paying their taxes and insurance in lump sum payments when they're due. Finally, there are borrowers who are required to set up an escrow account, such as borrowers who have less than a 20% down payment, which means private mortgage insurance is required. So how does it work? If an escrow account is set up, then each month a mortgage payment is made, a portion of that payment will be placed toward property taxes. This means when property taxes are due, they are automatically paid from the escrow account. Homeowners insurance may be included, and the most common one is PMI, aka private mortgage insurance, which again may be needed if you have less than a 20% down payment. Next slide, please. So speaking of PMI or mortgage insurance, let's dive a little deeper into what is mortgage insurance. First, there are many acronyms for mortgage insurance, and they all really refer to the same thing. Mortgage insurance is also known as MI. It can also be known as private mortgage insurance, PMI, or mortgage insurance premium, MIP. So what is it? In exchange for making a lower down payment, mortgage insurance helps the lender in the event that something unfortunate happens that causes you to default on your loan. Again, it is to protect the lender. Mortgage insurance may be mandatory for most loans if you put a down payment that is less than 20% of the home's value. It's very common. As far as the cost of mortgage insurance, it really varies by lender and depends on factors such as loan size, credit score, and loan to value. Next slide, please. Now that we've discussed how to be prepared for buying a home and attaining a loan, we're going to cover the buying process, which starts with getting pre-qualified, determining affordability, and understanding your budget. Then selecting a realtor, determining your needs and wants, touring homes that fit your needs and wants is a match, making offer for the home that best fits your needs, and then we have an accepted offer, we open escrow, and begin the contingency period. So let's start with getting pre-qualified and determining affordability. Next slide, please. First, you will need to get pre-qualified for a home loan, which will help provide realistic expectations regarding a monthly payment and home purchase price that is within your budget. Utilizing tools such as a mortgage calculator is a great way to get a better understanding of how your new mortgage payment will impact your monthly budget. Also, understanding the home purchase price that fits within your budget is very important for you and your realtor to know. So the realtor can ensure that your time is well spent by looking at homes that do not exceed the max purchase price or payment within your budget. Remember, the mortgage payment is just part of your monthly budget and expenses. So it's very important to create a budget that includes all of your housing costs and debts. This helps to truly determine affordability. For example, it's important to consider, besides just your home loan payment, the property taxes, as we mentioned, the homeowner's insurance, potentially private mortgage insurance. Then we have maintenance and repairs, homeowners association dues, if any, your utilities. Utilities can cost a lot of money on a month-to-month basis, depending on the size of the home and what utilities that you're going to have once you purchase the home. So make sure we consider those. Potential upgrades. Are there going to be upgrades that you're going to potentially want to take action on right away, or maybe a little bit more down the road? However, make sure that you budget for your potential upgrades as well. Then we think about credit reports and the impact of that, as well, as Janie mentioned earlier. Student loans, auto loans, your credit cards, upcoming vacations as well. We can if we have plans for that, is that within our budget? Kids going to school, then our necessities such as food. All of these things should be incorporated and put into your budget before making a decision of how much we can afford for a home. So it's important to not overextend yourself and ensure you still have enough money left over to place in the savings, which is always very, very important to sock away for a rainy day. Next slide, please. Once you know the approximate home purchase price. Next slide, please. There we go. Thank you. Once we know the approximate home purchase price and a payment that fits within your budget, it's time to find a realtor. Using a realtor is a very good idea, especially for first-time home buyers. During your search for a realtor, though, it's important to comparison shop. Since some realtors are more familiar with certain areas or demographics, and it's important to ask them questions to identify how familiar they are in the area that you are most interested in. So we want to ask ourselves, how well do they know the market? How knowledgeable and confident are they when you ask them questions about that market or about the home buying process in general? Perhaps how many homes in the area have they helped buy or sell? When comparison shopping or looking for a realtor, maybe ask friends or family for referrals. But make sure that this comparison shopping is based upon reputation. Check online reviews and do a little bit of research, which will serve you well so you have the best experience when searching for a home. Some ask if there is value in using the seller's agent, who may be more familiar with the neighborhood and area, or we would assume so because they're selling the home. Maybe, but it may be better to have someone who just has your best interest in mind while representing you. Ultimately, the realtor's role is to listen to your needs, be a resource for area information and market trends, and guide you through the selection, offer, and negotiation processes. And finally, help coordinate closing for all parties. Next slide, please. Once you have selected a realtor, it is important to understand the home type you want before starting a home search. Do you want a single-family residence, duplex, multi-unit building, PUD or planned unit development, a condominium or townhome, manufactured housing? There's so many different options, but again, it's important for you to understand what fits your needs. Likewise, it's also important to consider and narrow down the home features that will best suit your needs, such as how many bedrooms would you like? How many bathrooms are mandatory for the home that you're looking for? Square footage, perhaps the property size. Do you want a big backyard or a patio? And many, the kitchen layout. What is in the kitchen? Does it need upgrades? Is it in the right area? Many buyers are really obsessed with the kitchen layout as well. So it's different for every buyer. It's going to be different for you. Make sure you pick out the best home type and features before you start your home search. Next slide, please. So you're pre-qualified. You have a good idea of your budget. You've selected a realtor, and you know the type of home you're looking for. Now it's time to really start searching for a home. Your realtor will assist with your home search, starting with a system called the Multiple Listing Service, or in short, MLS, that typically only licensed realtors have access to. The MLS is a fundamental tool used by realtors to connect their clients with homes and or buyers more easily. So once you start visiting open houses, make sure to take pictures so you remember everything you see. Also, a best practice is to create a checklist with features that are most important to you and take lots of notes. Try to look past things you can change, like flooring, doorknobs, molding, paint, and other areas that buyers change and customize to their preferences over time anyway. Make sure to visit a home more than once at different times of the day and on different days, such as a weekday and on the weekend. This will help you get a good feel for the neighborhood, traffic patterns if you commute to work, or any other important factors that could impact your decision before making an offer. Once you've narrowed your search down to 2 or 3 homes you like best, make sure to research the homeowners association if there is one. What is a homeowners association? Some of you may be asking. Well, it is an organization of selected residents who determine the rules of the community it manages. Ultimately, it's responsible for ensuring that community rules are followed by all residents. In addition, the association charges all property owners a monthly fee that helps pay for the operation of the HOA and to maintain a cash reserve for community repairs. So again, make sure you understand the association rules, the monthly association costs, and the value you will get by paying your monthly HOA dues. Does it make sense? Finally, it's important to note that due to COVID, the home search is a little bit different right now. Virtual tours have replaced some in-person showings in order to help both you and your agent avoid unnecessary risks. So make sure you and your agents are following the Department of Real Estate's current policies and procedures. Next slide, please. At this point, you have found your dream home and made an offer. Once your offer is accepted, then you are in escrow and your contingency period begins. It is during this time that you're going to work closely with your loan processor, agent, and escrow officer to complete all of the aforementioned items we discussed during this presentation. You're going to go through a home inspection, a termite report, the appraisal, preliminary title, HOA details and information, your insurability. Once all that is done, you're going to have one last final walkthrough, make sure that this is going to be the best decision for you, and then you're going to close escrow and get your keys. And congratulations, at this point, you've just purchased your dream home. And as a final important reminder during the escrow period, currently we have seen and we are aware of escrow scams where we're cautioning buyers and sellers equally to be vigilant and to always ensure you never send money to anyone whom you don't know. Please make sure that you always verify is the person and the company you've been working with through the entire transaction before you click a button or you send a wire. And with that, this concludes the presentation portion of the home buying seminar, and I will turn it back over to Luis before we begin addressing some of the great questions all of you submit to the chat box. I look forward to answering them. Luis?
Thank you to Janie Mera, Dan Kotlayich, and Mark Brancroft. And thank you to San Diego County Credit Union for taking time to provide us with all this great information today. We want to remind you that you can replay this webinar and others on our San Diego Union-Tribune YouTube channel. And thank you to everyone who joined us this morning. I hope to see you again for the next Free Together San Diego Business webinar. Check our website, SanDiegoUnionTribune.com, for details on that. And thank you everyone at home for watching. Have a great day.